So let's talk a little bit about what we are going to cover today. The real reason why I wanted to do this is because I just had a big desire to help more people retire with confidence, okay? But what I want to do is at least get you on the right track. And a few other things I want to talk about is, if you're working with a financial advisor or financial planner, I want you to know what to expect, okay? Because something that is really interesting is that I like to ask people when they do an initial consultation with me is if they have a current financial advisor, I say, well, what besides investments is your financial advisor doing with you? And you'd be surprised how many times people just sit there with a blank stare and say, well, what do you mean, Jason? What do you mean outside of investments? Well, I believe these days investments are really just a small piece of the pie of what your financial advisor should be helping you with. And if you're not receiving additional services, you may really want to start questioning that, or maybe search for somebody that's going to be a better fit for you going into retirement, okay? Because prior to retirement, we call that the accumulation phase, and that's just where you're saving and saving and saving. Overall, that's a pretty simple phase as long as you are consistently saving and you're saving enough to meet your long-term income needs. Once you get to retirement, we have what we call the decumulation phase. And the decumulation phase requires a lot more analysis, a lot more technical knowledge, and you have to worry about things such as when to choose Social Security, how to construct your pension to benefit you the best way, how to draw from your accounts, what account to draw from, and in which order. So these are all things that are going to come up that someone who's just helping you only with investing, they may not be able to help you on the tax side or how to integrate your Social Security and pension decisions. I want to just show you an example today. So I have to make sure we're very clear that this is just going to be and demonstration is for education purposes, and this is not in any way, we're not going to be able to cover the full financial picture. So let's talk about this. Ideally, what we're going to do today is we're going to do a 5-year countdown to retirement. And these are things that you should be thinking about starting about 5 years away. And we're going to cover a case study. And our case study is a little bit of a mix. We have one of the spouses that is currently retired, and the other one's going to be retiring in about 7 years. All right, so as you approach retirement, the decisions you make during the final years leading up can also have a significant impact on your financial security and your overall retirement experience. So by creating a detailed plan and making strategic moves during the last 5 years before you retire, you can ensure a smooth and successful transition to this new phase of life. All right, so the first step we need to do is assess your financial situation and set clear goals. So the first thing to do is reviewing your assets and liabilities. This includes reviewing your assets, which would be like your retirement accounts, investment portfolios, and real estate. So assets are everything you own, and then also your liabilities, such as mortgages, loans, credit, and other credit debts. That would be your liabilities. And so once you have these two together, and you can take the total of your assets and you subtract your liabilities, that's going to allow you to get a very clear picture of your net worth and your overall financial health. So we're going to call this case study our part 1, assessing your financial situation and setting clear goals. So our agenda is ideally to review your assets and liabilities. So for all of you, I think there was a few dozen of you that actually took advantage of that link I sent out. But you want to start with reviewing your assets and liabilities. We need to get a clear picture of your overall financial situation and understand where you stand today. And then the second thing is to calculate your retirement income needs. So this is something I'm not going to cover directly here, okay? This is you sitting down and doing a budget and understanding exactly how much money you're going to need to live and be comfortable in retirement. And the third thing would be to evaluate your projected retirement income. We will touch on that a little bit. And then we're going to talk about setting clear retirement goals and then completing a pre-retirement checklist. So where do we start when it comes to reviewing your assets and liabilities? We want to create a personal balance sheet to list all assets and liabilities. And then you want to update this balance sheet at least annually to track your progress. So there's plenty of financial tools. You can use an Excel spreadsheet. You can use a yellow pad. It doesn't have to be anything really, really fancy, but you want to have something that makes it easy for you to keep track of and evaluate. So we're going to jump into our case study today and talk a little bit about that. And we're going to be speaking about Jill and Bob today. So Jill and Bob's situation. So Jill is 58 and Bob is 62. Bob is retired and he's already on Social Security. So if you have not taken your Social Security decision yet, or if you have not made your Social Security decision yet, then we're going to talk about that a little bit. But Bob's already made his. Jill has not yet. But Jill's goal is to retire at age 65. And their annual spending need is estimated to be about $65,000 to $75,000 per year, including, all their goals and extras, vacations, and things like that. And their big questions are they on track for retirement? And will taxation be a big issue? Okay, so these are probably the same two questions you have, right? So that's what we're gonna dive into as our first case study today. And we call this your asset map. Why is it called your asset map? Simply because it looks like a big map with all of your assets on it, okay? So this is essentially a visual balance sheet of everything Jill and Bob own, what they owe, if they owe anything, which they don't here, and all of their current income streams and future income streams. So these folks here overall are about 7 years away, like I was saying, and they have done a good job, I would say, planning for retirement. So one thing we need to start with is just understanding, your overall financial situation. So for these folks here, we're going to have their joint assets here, down below. So we have their joint assets here. If you see any of these boxes here where there's just a dollar on them, those are just placeholders. Okay, these are placeholders that I added in after reviewing their situation so that I can have a reminder for myself, because these are things that I want them to be thinking about, and we'll get to these, but don't worry about those for right now. So these folks here, Jill and Bob, they currently have their primary home is on a 145-acre farm. They have a rental property worth about $50,000. They have some farmland that they rent out, and then their other joint account, they have some joint savings. Okay, so there's just a savings account here, and these are all of their joint assets. So Jill is currently working, like I mentioned. So Jill's making about $100,000 a year. And these two income streams here and here, they are renting out their properties, which is great. If you remember, I did a video not too long ago on creating rental income streams for yourself. And that it could be a really wonderful thing for retirement. But I want you to keep in mind that if you have rental income, you're renting property or you're renting a home, you still have a part-time job. Okay, so even though you're quote unquote in retirement, it is a part-time job. But for them, they said, hey, no big deal, easy to manage, so we're just going to keep them. So we are assuming that they're going to have this rental income throughout their retirement time frame. Jill has not drawn her Social Security yet, but she's thinking about drawing at 62. So that's why it's grayed out, because she's not receiving it yet. All right, Jill has a 401k from one job that has about $105,000 and another 401k that has another $500,000. So she has $605,000. And this is all pre-tax money, okay? So this is going to be important. We're going to talk about this in a second. All pre-tax money. Bob's side, we have another set of accounts here. Bob has a 401k worth $230,000, all pre-tax. He has another 401k worth $15,000 pre-tax, and he has a Roth 401k with about $20,000. So this is one of Bob and Jill's regrets, is that they wish they would have had more Roth money earlier. So when I see a lot of pre-tax money in retirement accounts, that's the first thing I think about as a retirement planner, is that every single distribution is going to be a taxable event, okay? We have $20,000 here, so we're not, I shouldn't say 100%, but very, very close to all that is gonna be a taxable event. There's gonna be a big value to these folks by thinking about doing a Roth conversion. If you've never heard of a Roth conversion before, what that means is you're gonna take money that's in a pre-tax account today, and you're gonna do a direct transfer to a Roth account, like a Roth IRA, and yes, you will pay taxes on that transfer today, but then forever, that transfer will be tax-free as it grows over the course of your retirement time frame. But this is the overall synopsis, high level of their overall financial situation in visual form. All right, and now here's their balance sheet. So these folks here all together have about $870,000 of retirement assets, $5,000 of cash, and they have about $680,000 of real estate of some sort, or real assets, for a total net worth of $1.615 million net worth. So really beautiful situation. This is what we call the millionaires next door, that these folks, just talking with them, they built this up in one lifetime. They saved, they were diligent, and they invested. And so these folks are what we call our next door millionaires. And this is a very, very common situation that I deal with. It's kind of my specialty here, is helping these first generation millionaires. So now we have a good understanding of what we're looking at here, right? So we understand, we know the financial situation. We have a $1.6 million net worth, and you may have more than that, you may have less than that, okay? But the fact is, everybody's in a different situation, and it's not meant to make anybody feel bad or feel less than. This is just a case study that got submitted. Okay, so now, what do we need to look at here, okay? So what do I look at as a financial advisor when I'm looking at this stuff? I start to see, as many of you already noted, okay, we're gonna talk about looking at ideas for possible tax planning scenarios. We're going to look at ideas and see, are they on track for retirement? Okay. So I've already gone ahead and done a little bit of work here. So what I've done here is what we call a target map. Okay. So this is just a quick assessment to see about where Jill and Bob are on their retirement time frame. So after discussing with Jill, and Jill told me, she said, hey, I need about $65,000 per year to live on, maybe 75 if we're going to spend a little bit extra on other things, but that's very consistent and we know where we're at. Okay. So based on that, what I found is if they receive, okay, on their investments, and this is a very big if, okay, because there's a chance that Jill's not investing her money. I don't know that yet. I haven't looked at her statements at this point. But if they got a 5% annual return on their money throughout retirement, which that's pretty much a moderate mix, on your portfolio. That's somewhere between, a 50 to 65% equity ratio in retirement. And that should get them to their goal pretty consistently. And if that's the case, and this is assuming, by the way, they keep their rental properties, okay? Because that's about $17,000 a year of that $65,000 that they need or $75,000 that they need. And so that's a big number. So if they sell those, then we do have to turn those assets into usable, income. But if that's the case and they live till 90, okay, till 90, which again, that's probably a little bit beyond, it's beyond the average today, but there is a 52% chance that one of them could live till beyond 90, possibly even 100. So I did run that scenario as well. And based on that, these folks here are, looking still probably a little bit overfunded. Okay. So when I'm looking at a retirement situation, I have a lot of fancy tools. Okay. You have to know how to use these tools. You have to make sure all the inputs are correctly because they can really throw you off. But this is what I do. So when I'm looking at a new client situation, I'm going to run some quick scenarios to see, okay, how are they looking on retirement? How are things looking overall? And from a basic retirement standpoint, once we understand their basic needs, are they looking like they're in good shape? And Jill and Bob are looking pretty good. And the thing with Jill and Bob is, they do have kids, okay? But their goal was not to necessarily leave everything behind, all right? That was not their goal. We definitely discussed that, and they definitely wanted to spend a little bit more of their money. Will they? We don't know. Okay, that's something to think about. But after looking at the situation, some of the other things I took away were that Jill is age 50 and older, right? And she's still working. So Jill can qualify for catch-up contributions on her 401k contributions. And if she decides to start contributing to a Roth IRA, she is below the income limit for a Roth IRA. And even though Bob is not technically working, she can still do a spousal IRA for Bob if she wanted to. So for 2023, they can each contribute $7,500 to a Roth IRA under Jill's name and a $7,500 under Bob's name. So that's $15,000 to a Roth IRA if they wanted to do that this year. They can also contribute not only the $22,500 401k contribution that they can put in generally prior to age 50, they can also contribute an additional $7,500 to Jill's 401k if they wanted to defer the $30,000 of her income for this year. Okay, so that's something we can think about. Bob is 62, so Bob has to worry about healthcare, but more than likely Bob's on Jill's healthcare since Jill's still working. And Jill said she wanted to work until age 65, not have to worry about any healthcare prior to Medicare. That was one of her goals, so I said, that's great, okay? A couple other things that I'm wondering here is for each of her accounts, are they in the preservation stage? There are 3 stages to retirement planning. One is accumulation, and that's basically from when you start working all the way until about maybe 5 to 7 years before retirement. About 5 to 7 years prior to retirement, you should be thinking about the preservation stage, okay? This is not the year when you want to just try to go full bore and get as much returns as you can in your account. That's not a smart idea because if you look at 2022, until now, basically, we're still down from last year. That's going to really put a bummer on your retirement planning, or put a damper, as they say, on your retirement planning. So about 5 to 7 years out from retirement, you should be starting to buffer some of your assets, okay? And we'll talk about that a little bit as well. So that's something I'm wondering about their accounts. And then the other thing I'm looking at is, they have about $65,000 in cash, but they have no taxable investments, which is brokerage accounts outside of retirement, and they have very minimal Roth investments. So that's a pretty low number when it comes to being about 58 and about 7 years away to retirement. Ideally, I want them to have about 2 years to 5 years worth of very, very safe assets. So we can keep those assets safe inside of the 401k if we wanted to allocate it that way. And that can be part of our preservation allocation. But these are all things that I'm starting to think about as of right now. Other things I'm thinking about are, should we be looking at tax planning for required minimum distributions? Okay. So required minimum distributions are what happens to any sort of pre-tax retirement account. So pre-tax 401k, pre-tax IRA. So traditional IRAs, traditional 401ks. At age 73, if born prior to 1960, you're going to have to start taking required minimum distributions to your retirement accounts if you have not done that yet. If you're born in the year 1960 or later, now your RMDs start at age 75. Okay, so that's going to be starting in a few years. The key to remember here is, even though these tables have changed, because currently as of 2022 and prior it was age 72, now it's bumped to 73 or 75, it does not mean that the distributions are going to shrink. So if you don't do any planning for required minimum distributions, you may get a big nasty tax surprise. And what I'm seeing in Jill and Bob's situation is they have a lot of foundational income with their 2 Social Securities and their rental income. So there's a good chance that they're going to have a big RMD that they're not going to need, and that's going to be taxable income later, that if we plan, we can avoid that and help them lower that. All right, and then the other things I'm thinking are, do we have our buckets set up, okay? I'm also looking at their savings and saying, hey, is this $65,000? Is this really enough in our retirement savings? The other thing you want to think about is not just Roth conversions. We want to think about distributions, because if there's a tax bracket that looks like it could be a good conversion bracket, it might also be a good distribution bracket to add to our cash savings, early on in retirement, if we have lower tax brackets prior to all the income sources kicking in or the required distribution kicking in as well. So is this enough money? If we're going to say take, 30K maybe for an emergency fund, if their expenses are about 60 to 75,000 a year, let's call it 6,000 a month. 3 months would be 18,000. 6 months of savings would be 36,000. So somewhere in the $30,000 range is probably a good number. So that would only really leave us 35K to pay for those conversions if we wanted to pay the taxes outside of the IRA or 401k account. So that is ideal, by the way, if you can do that. It's not a requirement, and it's not the end of the world either if you don't do that, but that's your ideal. So Jill's, again, we're 7 years away here, so this is great. We have a lot of options here and a lot of time to start thinking about planning here. But these are some of the things I'm starting to look at. So let's talk about the 2 C words, okay? We have contribution and we have conversion. Roth contributions each year per person, if you're age 50 and older, are $7,500 each. Okay, that's $6,500 for your normal contribution, which anybody can do, age 18 or above, and the extra $1,000 catch-up contribution once you hit age 50. That's contribution. The other C word is conversion. Okay, and that's when you're converting money from a pre-tax account like a traditional IRA or 401k to a Roth IRA. The conversion has no limits. You can do as much as you want to convert. Do I recommend you convert your whole account in 1 year? Absolutely not. The key there is to figure out what the target tax bracket needs to be, and we'll talk about that in a future session. But 2 C words, contribution and conversion. So we need to talk about setting some clear retirement goals. So I like the idea of using SMART goals because it makes things very simple. So based on our initial assessment, we want to assess whether we have established specific, measurable, achievable, relevant, and time-bound goals. Those will be called SMART goals for retirement. So for Jill and Bob, she wants to retire in 7 years. She looks great for 7 years. She might be able to retire a little bit earlier, but she's happy. She likes her job. And honestly, this is a real tough one because, very few people really enjoy just sitting around all day. Some people really do. And some people have really, really tough jobs where they just have very physical jobs, and more power to you if you want to just enjoy relaxing. But 65 now is a very young age for many people. So it's a very real problem that you might be bored out of your mind, by the way, if you retire at 55 or 60. And there's a lot of data now that's showing that if you retire too early, you actually have a higher probability for health issues or potential mental issues because you're just not using your brain and your body. So think about that. But that's one of her specific goals is to retire with confidence by age 65. She's good there. Other things to think about would be setting aside a specific amount of money for retirement by a certain age. So, this 4% rule is generally an okay guideline, but it's something to where you can end up with a lot more money than you think you need. And if you don't plan and you just keep taking 4% when the markets are down, you could have a chance of running out of money as well. So you have to be really careful with that rule. So I like a dynamic strategy. But if you can start with a very safe number for withdrawal, or if you look at your expenses like Michelle and Bob and you say, hey, they need $65,000 to $75,000, they're overfunded for that at a 5% return, we're looking good. That's a good place to start. We're going to get much more specific than that in future sessions, but again, something to think about. The next thing to think about, paying off high interest debts within a specified time frame. So you do not want to go into retirement with any sort of credit card debt. That's a number one for sure. If you can eliminate all debt, that's great. But the reality is that's just not going to be possible for most people, or for a lot of people, I should say. And so the key is like, well, how does your retirement look if you go into retirement with a mortgage? When is it going to be paid off? What does that look like? Are you going to go into retirement with the car payments? These are all things to think about. When interest rates were very, very low and you can get car payments at 0 and 1 and 2% interest rates, it didn't really make sense to take a big chunk out of your retirement. You could probably invest that money and do better than if you just paid it all off. Like today, you can get about 4.2% in a high interest savings account very, very safely. So if you can get 4% on high interest savings and your car loan is at 1.99, well, mathematically it makes sense to do that. If you're a big Dave Ramsey fan, then all debt is evil and it doesn't matter about the financial side and you just want to pay it all off, and that's okay too. Next thing is building an emergency fund that covers at least 3 to 6 months of living expenses. Okay, that's very important. You want to make sure you have that. And then achieving a target asset allocation in your investment portfolio. So remember when I talked to you about your preservation mix. Okay, so you're going to have to shift your portfolio. Accumulation is different than preservation, and it's different than distribution. So all three of those phases in your retirement portfolio need to look a little differently. The target date funds that are available in probably 90% of your 401ks, it's an okay solution, nothing wrong with them, but it may not be the all-in-one solution you need. So you may need to separate the money into possibly a little bit higher risk and a little bit lower risk as well, but something to keep in mind there. And then you want to break your long-term goals down into smaller short-term milestones that you can work towards on a year-to-year basis, okay? The worst thing you can do is overwhelm yourself. So by keeping things simple and breaking down your goals into small steps that you can achieve, by the month, by the quarter, or by the year, it's going to be a much better experience for you versus trying to do everything all at one time. So I recommend that definitely. And then you want to develop an action plan to achieve those goals. So if you're behind on retirement savings, for example, you want to look at create an action plan to figure out, okay, well, how much do you need to save and by when to make sure that you're on track? So if you're 5 years out or more, you have some time. If you're coming down to the final wire here where you're about a year or two away, you may not have quite as much. From there, you want to monitor your progress regularly and adjust those goals as needed based on the changes in your financial situation or your retirement needs, okay? All right, so let's talk a little bit about cash flow issues. These are some things that you definitely want to think about if you are within this 5-year time frame, because cash flow and making sure everything is organized in one place is really, really important. And if you miss something, then this could be something that really puts you in a bad spot later down the road. So first thing is, will your cash flow needs change? Some of you commute a lot. So you put a lot of miles on your car. You use a lot of gas, or you have to have very expensive clothing, Well, your cash flow needs change. Because if your needs are going to be less in retirement, then that could be something that makes it a little bit easier. But for a lot of people, they go up, by the way, because a lot of people have very simple needs prior to retirement, but then they get into retirement and now they want to do a lot of fun stuff because they might have been working 60 hours a week before. So that could be something to think about. Second thing, will you receive a pension? And if you receive a pension, well, now we need to look at payout options. Are you going to take the single option, the joint option, the lump sum option? We're going to need to coordinate that strategy among your pension, Social Security, and or life insurance. These are all things that need to be integrated together, okay? Another thing here, could there be pensions and or retirement benefits from a previous employer that you may be forgetting, okay? This is something, a crazy number. So I was doing some research recently on 401ks, and I saw that there's an estimated, I think it was $1.3 trillion, trillion with a T, that is lost in misplaced 401ks. That's just out there, okay? So definitely want to do a search for any lost or missing 401ks if you potentially have them. All right, next thing, are you retiring early? If you're retiring early, and what that means is prior to 65. So you're gonna have to think about healthcare, you're gonna have to think about other options. You might have to think about providing for yourself longer. A lot of things there that you might need to think about. Will you or your spouse receive a pension from an employer that did not withhold Social Security taxes? Because if that's the case, you might have what's called a Social Security Windfall Elimination Provision or Government Pension Offset, okay, GPO or WEP. Those two things could come into play. Are you currently married? If you're currently married and you have two Social Security benefits, then we may be able to optimize those benefits. So with Jill and Bob, we're going to talk about that because Bob's already taken his, but Jill hasn't. So we're going to talk about how to optimize that. Were you married previously or are you currently unmarried? Because if you were married for 10 years or more, you may be able to claim on your spouse's Social Security record. And if that's the case, then you may be able to get a better Social Security outcome if that's your situation. Healthcare and insurance issues. Will you be retiring before age 65 and need health insurance? In Bob and Jill's case, no. Will you have to change your employer-sponsored health insurance upon turning 65 or retiring from your employer? That would be going on Medicare, for example. That could be possible. Will you need additional insurance, such as vision or dental coverage? Vision and dental, again, if you have glasses, that's going to be a possibility. Dental, unless you can get some sort of like group plan of some sort, it really seems like dental is better off to just be paid for as you go. For the most part, not always, but you want to do your research here. But don't feel bad if you look at the dental policies, as I did, by the way, since I'm self-employed. And most dental policies wanted to charge me $150 a month. So that would be $1,800 a year. And then they would give me $1,800 in coverage. So I'm kind of just paying in advance. But then what I found out is if you pay cash prices, you can get a discount. With insurance, sometimes you pay more because the dentist has to bill the insurance company. So they charge for that. So if you could just pay cash, then maybe retirement dental coverage is not right for you, but it's something you want to look at. Are you contributing to an HSA? If you are, and you go on Medicare, you can no longer contribute to an HSA, so you might have to change that, okay? So think about that. Will your MAGI exceed $97,000 if single or $194,000 if married? Are you disabled? If so, you might qualify for other benefits. Have your life insurance needs changed? If you are funded for retirement, do you really need life insurance anymore? Not really. You might want to have a burial policy for you and your spouse, something that just pays out if you were to pass away. But do you need to carry a massive life insurance policy? Unless you just want to, you can. But if you're not financially independent, then you might need to keep that life insurance policy. So that becomes part of your cash flow needs potentially. Or you can possibly have the life insurance policy, if it's a cash value policy, start paying for itself. That could be something as well that, that comes up. So again, these are all things to think about. Long-term care. Are we thinking about long-term care? Because long-term care is something that, a lot of people just don't want to pay for it, to be honest. They really don't. But it was about a 45% chance that you or your spouse, if you're married, are going to end up on a long-term care policy or a long-term care situation. They say 70% of people need some sort of long-term care, and 45% of people are on a longer stay, okay? So the average stay for men's about 1.5 years, last I looked. Average stay for women's about 2.5 years. So if you had to pay for 4 years of long-term care, could you cover that? If not, then you might want to think about long-term care insurance. If you have long-term care insurance, does it need to be reviewed to ensure it meets your needs? So this could be really important for you. All right, asset and debt issues. Do you have stock options, grants, or restricted stock units? That's something that's got to be planned for. Many people might have been granted stock and that didn't pay out all the way prior to them retiring. So you might still get payouts 1, 2, or 3, or 4 years away after you retire. So this is going to be income that comes in. So you got to think about this. That income generally is considered capital gains, so it does not affect your Social Security income, but it may affect if you have vacation pay and things like that, they may affect your Social Security income. So yeah, the 97,000, let me go back here. These MAGI limits here, okay? Most people are not gonna be over $194,000 of income. So if you're married, it's usually not a problem. But what happens is if one spouse passes away and you have a good Social Security, maybe a pension, or just big RMDs, it's very easy for people to get over $97,000 in income. So Leanne was 100% correct that if you are over $97,000 of MAGI, so that's all income, okay, as a single filer, single tax filer, then you could be subject to what's called IRMA, Income Related Monthly Adjustment Amount, which is call it a tax. It's a penalty. And that could be anywhere from, $800 or $900 a year up to $3,000 to $5,000 a year, okay, depending on how high your income is. So good job, Leanne. Will your investment objectives or risk tolerance change? Most people don't have the same risk in retirement as they did prior to retirement, right? Because if you're still earning an income, you usually don't stress about your accounts too much. But once you have to rely on your retirement accounts for income, then that could be a little bit more stressful. And I think I saw a question that said, how much, what's a target percentage for overall portfolio that should be in Roth versus pre-tax? Mike, the ideal is 1/3 in each, right? Pre-tax, post-tax, which is a brokerage account, and then tax-free, ideally. But not everyone's gonna be able to do that. All right, let's continue on here. Are you a business owner and do you need an exit strategy or succession plan? If you have annuities or illiquid assets, do they need to be reviewed to understand options? What I find, folks, is so many people have these annuities that honestly, they did not go to a true comprehensive financial advisor. They went to a salesperson, they went to a chicken dinner, some sort of seminar, and they were sold on this product that just sounded like the best thing in the world, okay? Not saying all annuities are bad. All I'm saying is you want to make sure that they're right for you and your situation. And if you're somebody that has 2 Social Securities between a husband and wife, and you have a pension, for example, do you really need another guaranteed income stream? Maybe or maybe not. The way I like to use annuities, if we're going to use them, is to give what we call that floor income, meet the floor income. So if you have, let's say, a minimum income need of $50,000 and your Social Security is going to provide $35,000, for example, well, then let's get $15,000 a year in annuity to meet that $50K. That'll just bring you some peace of mind. A lot of people don't need to do that because you could just keep that in something like a money market account or a high interest savings account these days. But it can make people feel better if they have that from an annuity perspective. So something to think about. All right. Do you have any loans on your retirement plans? Okay. This one is a big deal because most retirement plans, like 401ks with loans, are going to require you to pay those back prior to retirement. If not, it may become a distribution. So that can be income in that year. So you want to make sure you take care of that. Do you have a deferred compensation plan? Because there's some things that you want to plan for. That'll be, again, taxable income at some point. And then do you have multiple accounts with similar tax treatment, like multiple 401ks or IRAs? So something to think about here is, if you have multiple 401ks or multiple IRAs, do you really need all these different accounts? Okay. My philosophy is keep things simple. You can generally consolidate everything into one account. So one IRA that takes care of everything. Because at 73 or 75, you're going to have required distributions and you're going to have to calculate that on the total amount. You can take the full RMD from any account that you want, but why deal with all that? It just sounds like messy and annoying. So that's something you want to think about, is maybe just to get things in one place, simplify them. All right, will you change your residence? Because if so, you're going to have some things you need to update, okay? So if you change your residence, this may impact your tax liability, your cash flow planning, and it could also impact Medicare Advantage if you move out of the network. And it also could affect your estate planning, by having to get your trust reviewed for that particular state, okay? Do you expect large required minimum distribution? So this is something, folks, if I really want to encourage you that if you have a large pre-tax account, get some advice on this, okay? I'm happy to help you out. You can reach out to me or find a tax-focused retirement advisor so that they can help you with this, because this is really important. And ideally, you get a certified financial planner. That'd be ideal. Upon retirement, do you expect your income to be lower? Okay. So if you expect your income to be lower in retirement, then you generally want to put your contributions today in pre-tax accounts, because you can just do the Roth conversion, as we talked about earlier, and convert those over when your income is lower. If you expect your income to be higher in retirement, then you probably want to do Roth contributions today, because your income's gonna be higher later, so you might as well pay the tax now, okay? Some estate planning issues. Very few people I know are gonna have a problem with over 12 million or 25 million in their estates. If you're charitably inclined, charitable contributions, you can still do QCDs, qualified charitable distributions from your IRA starting at age 70 and a half. So if you are charitable, you may want to consider giving directly from your IRA account. One, that can help you reduce your tax liability, but it also helps the organization receive that full amount of income versus you giving the after tax. Okay, so I have some more checklists about that if you need help with that. Your estate plan. You definitely want to update this if you are getting close to retirement, if you haven't done this in a while, and you definitely want to go ahead and review all your account beneficiaries. Make sure those are up to date and proper, and so that those are good. And then do you have any unused vacation days? Sometimes you lose your vacation if you don't use it. So if you have unused vacation days, make sure you're maximizing those. And then also make sure you're accounting for that, because you may get a big payout after retirement, and that can affect your overall tax situation as well. And then there may be some state-specific issues, okay? So, folks, these are checklist items. These are overall retirement planning items that I really want you to think about getting in order as you're making your transition here. So, like I said, if you found this helpful, I would love for you to join us on this series. The next one is going to be in a couple weeks. So in the next session, we're going to dive a little deeper on Bob and Jill's tax planning situation, because what we've already found is they're probably overfunded for retirement. They're probably a great candidate for Roth conversions or early distributions. And what I don't want for them is to have big required distributions starting at age 73 or 75 that they don't really need. That's just going to have to get reinvested anyways, by the way. They're going to have to pay tax on it at that point. So that will be our next step there, okay? So last chance for any questions here before I wrap up for today. And I see Pam asking a question. She said, after watching my father-in-law die from dementia at home and what that did to his family, you might reconsider. Believe me, he would have rather been dead, but not an option. This is real, right? Like, folks, these are conversations that I don't know how many people out there in the world of providing retirement guidance are going to have these conversations with you and talk to you about this. I just want to have this conversation because I know it's going to come up at some point. People don't want to deal with this. They don't want to think about it. But these are real situations, like Pam was saying, that it happened to her father-in-law. And it's sad, it's tragic. But if you plan properly and you have a good plan in place, and it's something that, the numbers make sense, it helps you sleep at night, and you have, backup for things that something were to happen, you're really showing your family that you love them if you plan and you do things properly. And if you don't plan to do things properly, it can be a big headache, and it can be very sad, and it can be something that, unfortunately, Pam or possibly her spouse had to deal with that. So, get your plan in place. We're going to continue on this in a couple weeks. And from there, we will, like I said, we're going to go deeper and deeper into the situations. And by the way, I should let you know, folks, I have a YouTube channel. You can find it either at Jason J. Hamilton or at Keep It Simple Financial. And you can watch a lot of videos there on all things retirement planning. I repost these videos there. They're also here on the page and in the groups, but I understand that things get lost, just from post after post. So the YouTube channel, if you want to go there, please subscribe, leave me some comments. I'd appreciate that. Let's see here. Connie, she's asking about insurance option tax implications. We'll talk about that later. Or maybe working part-time to supplement insurance costs. So Connie, here's an interesting thing about insurance. With the Inflation Reduction Act, there's a lot of bad things about it, by the way. But one good thing about it is that it has increased the limits that you can qualify for a subsidy for your health care, for ACA. My good friend Malia and I talked about this recently, so there's a video in the group where we talk about this. But that limit has been significantly increased. And so insurance for health care might be a lot more reasonable than you think. I've seen people's plans go down from about $500 to $700 a person down to $200 or $300. I've seen people now paying next to nothing for insurance. So this is something you want to evaluate before you just make an assumption that it's going to be expensive. So, make sure you get with an insurance broker to evaluate that. But you can work part-time. Definitely, a lot of people work at places like Costco. I think they provide health insurance for you, and it can be a great idea. Mike says he has a family member who had to go to a nursing home for skilled care for a few years. They had to sell their home to pay for the care. Mike, that is a very real situation as well. That is something where I will look at that sometimes as an ultimate backup, that if someone says, Jason, I really don't want to buy long-term care. I think it's a waste of money. I don't want to take the risk, or I'd rather take the risk, I should say, of not having it. And I will ask them, say, well, hey, if you run through your assets, are you willing to use your home equity to fund that? And that could be a good way to do it. Reverse mortgages are really a lot better than they used to be. And you could look at refinancing or possibly just selling. So that could be a real thing as well. So All good stuff, folks. So again, I hope you enjoy this. Once again, my name is Jason Hamilton. I am the founder of Keep It Simple Financial Planning. If you need help with this stuff, I'm happy to help you out. I'm going to pull up my actual website here, and I'll post it in the comments as well. But you can go to keepitsimplefinancial.com/talk, and I'm happy to discuss with you. But other than that, folks, I want to wish you a great day. And if you need anything along the way, feel free to send me a message, send me an email, and hopefully this is helpful for you. And if it is, please share it with a friend.